There's an unmistakable tension in the air these days. Reuters reports the largest U.S. military buildup since the Gulf War is taking shape in the region. But the real story is playing out in the markets. Brent crude, currently at $71.76, has gained nearly 2% this week alone. Gold, the classic safe haven asset, has surged to $5,130. Money control analysts attribute this 2.65% single-day rally to deep-seated investor anxiety. When you connect these dots, they all point to the same conclusion: we might be just hours away from a full-scale conflict. This deployment is so massive that the UK Defense Journal calls it the largest since the Gulf War. Let's put this in historical perspective. During the 1991 Gulf War, the U.S. deployed about 500,000 troops. Today, there are no ground troops, but in terms of air and naval assets, this buildup is even heavier. This signals a fundamental strategic shift. Air and naval warfare is faster. Goldman Sachs has warned that investors should brace for heightened oil price volatility, as any Gulf tension could trigger price spikes. Let's examine the details. CBC reported yesterday that satellite imagery analysis shows dozens of U.S. military aircraft at bases in Qatar and Jordan. The noose is tightening. Trump stated a few days ago that Iran has only a 10-day window to reach a deal, or bad things will happen. The Stimson Institute predicts that if war comes, the first 48 hours will be decisive, potentially neutralizing 50% of Iran's military capability. A swift, limited war, not a prolonged one. These F-35s aren't alone. They're accompanied by refueling aircraft, essentially flying gas stations that enable fighters to remain airborne for extended periods. Surveillance planes have also arrived. P-8 reconnaissance flights are now active over the Strait of Hormuz. Energy News reported yesterday that oil prices hit 6-month highs. This is no coincidence. The buildup didn't stop there. Dozens of F-16 Falcons and half a dozen F-22 Raptors joined the deployment. The F-22 is the U.S.'s most advanced fighter. Goldman Sachs offers an interesting analysis. If the Strait of Hormuz is closed and oil supply is reduced by 1 million barrels per day, prices could increase by $8. That's just the base case. If markets panic, the spike could be much larger. Now combine all these aircraft with the 2 carrier strike groups already in the region. The USS Abraham Lincoln has been in the Gulf since January, and the USS Gerald Ford is approaching from the Atlantic. 2 carriers now surround Iran. Reuters reported yesterday that Geneva talks show progress, but no deal yet. VP Vance stated that Iran is not yet willing to negotiate on red lines. The diplomatic stalemate continues. Russia, always a key player in these crises, took an interesting position today. The Kremlin officially urged Iran and all parties to exercise restraint and caution, prioritizing diplomatic means. Putin's spokesman stated the level of tension is unprecedented. This suggests that if war comes, Russia likely won't intervene, at least for now. For oil markets, this could mean a lower risk of the conflict expanding regionally. But here's the interesting part. Gold is now at $5,130, and analysts believe it could reach $6,500 by year-end. Central banks worldwide are buying gold. China and India, perennial buyers, are too. This is a long-term trend, not just a knee-jerk reaction to U.S.-Iran tension. That's why gold won't dip below $5,000. Saudi Arabia, perpetually in the middle, now hosts U.S. equipment, but more importantly, its oil exports dropped to the lowest level since September. 2 possible reasons: either they're bracing for a crisis or the global market is weakening. The UN reported yesterday that China's strategic reserves are being filled. China is preparing for any scenario. Interesting side note. Yesterday, Russia and Iran held joint naval exercises in the Sea of Oman and northern Indian Ocean. The Kremlin says this was pre-planned, not a reaction to current tensions, but the timing is telling. Iran is showing the U.S. it's not alone, though the Russians themselves insist they believe in a diplomatic solution. Remember I said something was missing? Stewart points it out. Ground troops. No soldiers for an invasion. This would be an air and naval war. For oil, this means infrastructure is the target, not occupation. After weeks of bombing, production could resume, but during those weeks, prices will spike. Goldman Sachs has another interesting prediction. Their base case assumes ships will pass through the Strait of Hormuz without long-term disruption, so they're assuming no war. But if disruption occurs and 1 million barrels leave the market, prices will rise by $8. That's just the base case. The USS Gerald Ford is also coming. 2 carriers. This is the first time in decades the U.S. has 2 carriers simultaneously in this region. Energy News reported today that oil prices hit 6-month highs. This 2% weekly gain is directly due to these tensions. Money Control reported today that global gold rose 2.65%. That's the expected reaction from a safe haven asset. The long-term forecast for gold is $6,500 by year-end and even $8,600 by 2027. That's why gold is becoming a serious long-term investment option. But not everything leads to war. VP Vance said yesterday they're assessing whether to continue diplomatic engagement or pursue other options. The diplomatic window isn't completely closed. Iran says talks were more constructive. Maybe this weekend brings good news. Energy analysts say that if the Strait of Hormuz is closed, 20% of the world's oil would be at risk. That's a terrifying number. That's why the market is so sensitive. But China, the world's largest oil importer, is filling its strategic reserves. They're preparing for any scenario. Iran isn't sitting idle. Satellite images published by Reuters show they're rebuilding the Natanz and Isfahan nuclear facilities. They're preparing for another attack. Remember last year when the U.S. hit Iranian facilities with B-2 bombers? Now they're repairing. Iran announced it held naval exercises with Russia in the Sea of Oman and northern Indian Ocean. A clear message to the U.S. I'm not alone. Though the Russians said it was pre-planned, the timing is a signal. Iran is playing all its cards. But a Rystad energy analysis says the worst-case scenario would only increase oil by $10 to $15. So even with war, oil wouldn't exceed $80 to $90. This differs from other analyses predicting $100. Analysts also disagree. In summary, it all depends on this weekend. Trump gave a 10-day ultimatum that ends soon. If no deal is reached, an attack could begin. But Geneva talks continue, and both sides mention progress. Maybe there won't be a war. A Bloomberg analysis suggests that even with war, the impact on the global economy would be less than 20 years ago, because economies are less oil-intensive. Now, $100 oil hurts less than 20 years ago. Maybe that makes Trump more willing to strike. For investors, Goldman Sachs recommends expecting volatility, not buying or selling now, waiting to see what happens. If there's war, oil will rise. If there's peace, it might fall. Patience and observation are best. Another interesting fact, central banks worldwide are buying gold. It's a long-term trend, not just a reaction to the current crisis. That's why gold won't dip below $5,000. If this continues, maybe in 2 years, gold will reach $8,600. The crypto market also reacted. Bitcoin dropped 4% in 24 hours. Money is flowing to safer assets like gold and the dollar. Investors aren't hoping for peace. In summary, next week is crucial. Peace or war, $100 oil or $70 oil, $6,500 gold or $5,000 gold. Markets are waiting. Everyone's holding their breath. We'll have to wait a few days to see what happens.